The biggest lie about annuities are these phony advertised rates of return. Like you might hear something about 6.5% or 7% returns guaranteed. So what's the catch? How is this possible? After all, an ETF portfolio of 25% S&P 500 stocks and 75% Barclays aggregate bond index returned only 5.2% over the bear market of the last 14 years. So how do the insurance companies do it? Are they losing money? After all, they pay advisors who sell annuities anywhere from 5 to 20% commissions up front, plus possible trailer commissions of 0.25% per year. Then they have tremendous overhead costs, and insurance companies are for-profit corporations. They have to make money. Certainly, if they keep this up, why, insurance companies are going to be going out of business. They're losing money. Have you heard the phrase, if it sounds too good to be true, it is too good to be true? The catch is they aren't paying you a guaranteed 6.5% or 7% return on investment when it's all said and done. They're only talking about annual return. There's a huge difference between annual return and return on investment, and the one that matters is return on investment. Now, to help you understand what's happening here, imagine a poor performing stock that pays a really high dividend rate, but the price of that stock slowly keeps declining. You invest $100,000 in the stock, you get your 7% dividends year after year, but by the time you die, the value of that stock has pretty much lost a lot of its value or even dropped to zero. That pretty much sums up how these index annuity products work. The goal of the insurance company is to lure you in with a high annual payout rate, but then systematically whittle away at the value of the lump sum of your money that you gave them, so that by the time you die, or by the time that you're in a bind and you need to cash out of that annuity, they've gouged you to the point that you will never get that advertised rate as a return on investment, even if you live to be 120. Never. The insurance company has all kinds of creative ways to whittle down the surrender value and the death benefit value of your annuity with high 3 to 4% fees per year. Any payments made to you are also subtracted. There's market value adjustments. They have nasty participation rate caps. They also take away dividend participation. Did you know that historically about 40% of stock market returns have been from dividends? You don't participate in dividend gains with these equity index annuities or index annuities. Insurance companies also reserve the right to change the rules of the game in the middle of the game. How convenient. Insurance companies have the deck stacked way in their favor so that it's a mathematical certainty that they are virtually guaranteed to come out the winner. And the whole time, what do you think they do with your money when you give it to them? They take your money and do what you should have done. They invest it in bonds and stocks. It's no wonder that whistleblower Clark Howard calls index annuities poison to your pocketbook. And it's no wonder that Chris Hansen from Dateline NBC's To Catch a Predator did an undercover story about annuity salesmen and how these sneaky clowns will do whatever it takes to scare senior citizens into thinking that bonds and stocks are too risky, and then sell them these high commission illiquid products that wind up doing worse. And once you sign the paperwork without researching what these crap products are all about, you're screwed. And it's not easy to find the real articles that critique annuities because 99% of the websites and videos out there are posted by biased annuity salesmen and insurance companies. The vast majority of people who sell annuities don't legally work for you. They're not fee-only fiduciary advisors who legally work for you. They're salesmen who want to make lots of money at your expense. They don't care a rat's ass about you and your financial future. So what you need to do is invest instead in simple index funds, ETFs. They're cheap and easy to buy, no liquidity risk. You can sell at any time for any reason. There's no surrender penalties, no contingent deferred sales charge. Basically, you just open up an account with Ameritrade, E-Trade, or Scottrade, and it can be as simple as owning 2 ETFs. For example, you could buy VOO and AGG. How much you invest in one versus the other? You could try Vanguard's portfolio selector, or Rick Edelman has a portfolio selector. And again, Mr. Annuity Salesman wants you to think that investing in bonds and stocks is risky. It is not. History has shown us that bonds and stocks balance each other out. And on the screen here, you can see this historical return of a portfolio of 25% S&P 500 stocks and 75% 10-year Treasury bonds. By the way, 10-year Treasuries are actually more volatile than an ETF like AGG. And if I could find a chart showing total bond market returns, we would expect to see even less volatility than in this chart here. And also, don't let Mr. Annuity Salesman tell you that a repeat of the 1929 crash and the Great Depression would wipe out your wealth either. I have a video debunking that myth. In reality, when accounting for deflation back then, at no point did the value of a 75-25 portfolio lose money.